What sort of unemployment rate are you looking for to get the Fed to cut rates in May?
So I think it's going to be more about inflation if the Fed were to cut as early as May. I think the bar is very high for them to go that soon, though. But I do still expect them to be ready by June. For the employment report, we're expecting another big number, around 245,000. Even if it comes in at 150,000, they'll say it's just one print. We're going to look at the unemployment rate. I think even if we get a very strong jobs number, we're going to keep the unemployment rate higher at 3.9%. And that's because so many people are coming into the labor market. And then you're still going to get wage pressures that are coming off. So when you talk about a Goldilocks scenario, right, that's going to be a report that says the economy is still strong, but it's not something that gives a definitive signal to the Fed that they need to cut very soon here.
Well, Chair Powell agrees with you that it's a bigger economy, not a tighter one, thanks to immigration. But you've put the neutral jobs rate of growth at 265,000 a month. Why is Powell's estimate of 100,000 wrong?
So, look, I had an estimate of 100,000 just 6 months ago. Essentially, we've gotten new data, and this is something that markets have to deal with, economists have to deal with. We have gotten significantly upward revisions to population growth in the U.S. And faster population growth means faster economy, it means faster growth in the labor market, and it also means that you're going to have a higher, what we call break-even level for employment, the amount of jobs you need to create in order to keep the unemployment rate steady. And so this is a supply-side story. That supply-side story is something that Chair Powell has been focused on since later last year. 2023 was all about improving supply chains, improving labor supply. 2024 extends that labor supply improvement where the growth in the population is just that strong. And so this is a real supply side story that is supporting growth in the economy without creating inflationary pressures.
I want to come back to where rates will go in a moment, but just staying on immigration, Ellen, it's going to be a key issue, of course, in the US election. If you get Trump 2.0, what sort of economic impact are you expecting?
So I do think that this puts the administration in a sticky spot because, according to our surveys, households list immigration as the second most concern, just behind inflation. Yet from an economist's just objective lens on the economy, faster population growth drives faster growth in the economy. And so it is a positive for the U.S. economy. It's been a positive for U.S. job gains. It's been a positive for U.S. consumption. But immigration itself is a hot button political issue. And so I think focusing on just the economic benefits from it will be something that needs to be separated on the campaign trail.
But then what's the flip side of that? If you have less immigration, could inflation strike again?
Well, I think that there is a question mark out there as to how much do immigrants contribute to inflation in the economy. Now, the U.S. is very different than other economies where we have low-skilled labor coming in. They're helping fill jobs the positions that are open where we need labor, and they come in at low-wage paying service sector areas of the economy that help bring wage pressures down. So that tends to not be inflationary in the U.S. That is very unlike countries like our neighbor Canada, where they have very high-skilled immigration coming in. 30% of their labor market is unionized. Those are high-skilled labor, and there's a lot of household formation and a lot of inflationary pressures that come from that. So the U.S. is quite different there. Now, that said, it's more of an economic growth rather than inflation problem if you were to have a shift in policy, you have a big drop-off in immigration, and suddenly you have a very big slowdown in population growth. Then that is more of a growth narrative, dampening growth and dampening inflation. So immigration is neither here nor there. It's neither inflationary nor deflationary for the immigration that we have today. But if we were to suddenly turn that off, then you would have an impact to growth and a gravitational pull on inflation as well.
Ellen, we were just listening to Janet Yellen speaking in China. She's talking about the issue of Chinese overproduction creating distortions. Do you agree with that concern?
So I think that this has been a lingering concern across many administrations that it's all about the global balance of supply and demand, and there is a risk always when a country like China that is so big exports what they call product dumping, right? Exports in a way that creates deflationary pressures in goods prices or creates unfair competition, unfair advantage. And this is something that many administrations have been focused on. It's something that will be front and center during a U.S. election year. And so I think this is something where the administration is there out in front of it, reminding folks that we do have a hard stance on China.
If we can come back to the monetary, you're in the beautiful Lake Como area in Italy. If the ECB cuts before the Fed, how much divergence would be a problem?
I don't think that's a problem at all. The Fed is on a track to cut rates, and not all on the FOMC agree that rates will be appropriate this year, but all but one believe that we will cut rates this year in the U.S. And so that market expectation of about 3 cuts this year, I think, is in line with the Fed's view. And I do think that that's in line with what the Fed thinks it will deliver. We expect 4 cuts. We actually expect them to speed up cuts in the fourth quarter of the year because we have inflation coming down faster at that point than the Fed. But I don't think that the timing of when central banks globally are cutting is really going to be an issue for the Fed. Markets already have cuts priced in as an expectation.
Well, the last thing any central banker in the world wants to do is to reverse course. Who do you think's most at risk of a U-turn?
Well, I think that the Fed has communicated that it will cut. It's likely to cut. Real rates are already quite restrictive, and you don't want them to get further restrictive if inflation continues to fall. So the risk there, of course, is inflation doesn't fall. If this immigration story provides so much strength in the economy and it starts to become inflationary, right, then it's not necessarily, it's reversing course in a sense from we were set to cut and then we're not going to cut. I think the bar is just too high to get to a point where they're going to be willing to start hiking again. But I think the strength of the U.S. economy really stands apart on the global stage at this point. So there is that risk that Kashkari pointed out that they don't cut at all. But I don't see anything in the forward-looking data that suggests they should not stay on this cutting track.
Okay, that's really interesting. You're going to be meeting your colleagues from around the world there today. I wonder, Ellen, what's the one global economic challenge that's keeping you up at night?
So I do think it's these, I keep coming back to immigration. I cannot talk about the U.S. or global outlook without talking about immigration. I think immigration is front and center because these are tectonic shifts that we're seeing around the global economy with very different implications globally. I was having a conversation with colleagues at the Bank of England last night about it. Very interesting differences in immigration between the U.K. and the U.S. I mentioned Canada earlier. I also think we do have to keep an eye on China. China has not done as much stimulus as our economists there had been calling for. You need targeted stimulus toward Chinese households in order to stimulate that side of their economy. And of course, if you get into a debt deflation cycle in China, that is going to impact the global economy.